Hello, we're going to record the transaction for the receipt of cash from a client for work that is done. So the assumption here is that the work and the cash was done at the same time, meaning we did the work and we received the cash at the same time at the completion of the job at that same point in time. We're going to record that in terms of our accounting equation, which is, of course, assets equal liabilities plus owner's equity. And we can see that we have our list of accounts within assets. These are the things we need to start to memorize. Some of those accounts are going to be cash, accounts receivable, supplies. Liabilities, an account type would be accounts payable. That's the main one we start with liabilities. Equity, we have capital, the amount owed to the owner, as well as the income statement, including revenue minus expenses. So remember, we have both capital account and the whole income statement as part of the owner's equity or just equity section when we're talking about the accounting equation. We currently have cash already before this transaction of $70,000. And we have capital of 70, therefore we are in balance. As we start, when we think about this transaction, I usually ask the question, is cash affected? And of course, it is affected in this case. We got more cash. So cash within the asset section will go up. What will be the other account? There's always going to be at least two. Who gave us the cash? Well, the client gave us the cash. The customer gave us the cash. And therefore, we earned revenue. Revenue is on this side of the equal sign. Remember that revenue and cash are not the same thing. Revenue represents us earning the money. Cash represents a form of payment. Note, we could have got another form of payment. We could have got a receivable or something else. When the form of payment and the time that the work is done are at different time periods, then we'll see that difference more. So if we were to record this, then we would say that what happens? The assets are going to go up. And if we were to record this in this type of format, we started off with 70. Cash went up by 7. Now we have 77,000 in cash. That's what this is saying. In this transaction, the other side was revenue went up by the 7,000. So now if we look at the capital and the revenue, that adds up to 77. So we're still in balance. Both the transaction is in balance as well as the balance after the transaction is in balance. Assets overall went up because cash went up. No change to liabilities. The equity section also went up. We can see the equity section went up by revenue, and we are in balance, of course, over here, meaning assets equal liabilities plus owner's equity, and then net income went up. Where is net income fitting into our accounting equation? It's the income statement. That's revenue less expenses. So revenue went up 7,000 minus expenses. Don't have a change right there in our transaction between these three areas. 7,000 minus 0 minus 0. That's the change in net income.